Hello and welcome to my YouTube channel, Study with Umair. I will be doing a number of videos on the topic of finance for non-finance managers, and this is the first video. In this video, we will be discussing the definition of accounting, the heads of accounting, and the rules of debit and credit. So let's start with the definition of accounting. Accounting can be defined as the process of identifying, recording, classifying, summarizing, analyzing, and communicating transactions and events. What actually happens when a business is in process, certain number of transactions take place on daily basis. So first of all, we need to identify what's actually happening. Once identified, then we record these transactions, maybe in a register or on a computer, and it can be anything. Once recorded, we also need to classify whether the particular item is an asset, expense, liability, and so on. And then we summarize. When a large number of transactions occur, we gather them and summarize them. And after summarizing, we analyze how the business is doing. Are we going to get our targets? Is our profit increasing or not? And so many other things. And once all this has been done, we communicate these reports or information with the shareholders or with the owners of the organization, with the top management, employees, government, and several other stakeholders of the business. Heads of accounting. We must have come across so many heads while we actually work in our business life, like salaries expense, rent expense, building, creditors, debtors, and so on. But all these heads can be generally categorized into 5 main heads of accounting: assets, liabilities, equity or owner's equity or capital, expenses, and incomes. So there are 5 main heads of accounting. We will see each one of them now. Assets. Assets are the resources owned by the organization. With the help of these resources, organization creates revenue, hence profit. Example, buildings, vehicles, cash, merchandise. And now when we talk about assets, we have 2 broad categories: non-current or fixed assets and current assets. So first of all, we will look what non-current assets are. Non-current assets are those assets which have the useful life of more than 1 year. In other words, the assets from which we can extract benefit for a period more than 1 year is a non-current asset. For example, property, plant, and equipment create revenue for the organization for years and years. Current assets are those assets which are expected to be converted into cash in 1 or less than 1 year. For example, cash itself, the bank balance, account receivables, we expect our receivables to be converted within 1 year. Now the liabilities. Liabilities are simply what an organization owes. Present or obligations arising out of past events. An event has occurred in the past and organization currently owes it, and resulting in the outflow of resources because organization has to settle it, has to pay it back, maybe in the form of cash, some sort of services, inventory, and it could be anything. So resulting in the outflow of resources, for example, bank loans, debentures, accounts payable, etc. And just like assets, liabilities can also be divided into 2 main categories: non-current or long-term liabilities and current or short-term liabilities. So first of all, non-current liabilities. These are the liabilities which an organization has to repay in more than 1 year. Means the creditor has allowed the organization to repay the loan in more than 1 year, such as bank loans, debentures, etc. On the other hand, current or short-term liabilities are those liabilities which are to be repaid in a period of 1 year or less than it, such as bank overdrafts, account payables, So many organizations purchase different goods on credit for a period like 1 month, 2 month, or 3 month accounts payables. All these things may be covered under the category of current or short-term liabilities. And then capital or owner's equity. In the simplest of words, capital is the investment by owners. Whatever has been invested by the owners themselves into the business is the capital, such as ordinary share capital, share premium, retained earnings account, etc. Expenses. Expenses are decreases in economic benefits in the form of outflows or depletion of assets or incurrences of liabilities, and result in decreases in equity other than those relating to distributions to equity participants. In the simplest of words, expenses as it is written are decreases in economic benefits. But remember, whatever concentrate on this line other than those relating to distribution to equity participants. So whatever distribution an organization makes to its shareholders or its owners, this is not included in the category of expenses. Other than that, all the decreases in economic benefits are included under the category of expenses. And we have the examples of salary expense, rent expense, marketing expense, and so on. And income is the opposite of it. Now here incomes are increases in economic benefits. And once again, concentrate on this line other than those relating to contributions from equity participants. Any contribution coming from shareholders or the owners of the organization shall not be considered as an income. Other than that, all the incomes or inflows in economic benefits shall be considered as incomes. Examples: revenue, commission income, rent income. Now it's very important to understand, in fact, to understand as well as memorize the rules of debit and credit. First of all, we need to understand what debit and credit are. You must have heard accounting or finance people speaking about this very often. Debit, credit, debit, credit. Debit and credit in the simplest of words is the left-hand side of an account is debit and right-hand side of an account is credit. As simple as that. So left-hand side of an account is debit and right-hand side of an account is credit. Now there is a rule which we need to keep in mind when we are passing the entries, accounting entries. The rule is that if assets and expenses increase, they shall be debited. And if capital, liabilities, and income increase, they shall be credited. I repeat, when assets and expenses increase, they shall be debited. And when capital, liabilities, and income increase, they shall be credited. And vice versa, when assets and expenses decrease, they shall be credited. When capital, liabilities, and incomes decrease, they shall be debited. Now let's take some illustrations to understand these rules, the application of these rules. Transaction number 1, entity purchased building and made payment in cash. Here an organization is purchasing a building and making payment in cash. So what's actually happening here? Building is an asset, it is increasing. We shall debit it according to the rule. When assets increase, they are debited. On the other hand, we are paying cash. So cash as an asset is decreasing, so we shall credit it. Transaction number 2, entity purchased building on credit. Now this building has been purchased on credit. So the company has not yet made the payment. So it is incurring a liability. How? Building, once again, asset increasing shall be debited. Now instead of cash, because the cash is not yet paid, a liability is arising, accounts payable. And liability is increasing, so we shall credit it. So accounts payable is credited. Transaction number 3, entity paid salaries expense for the month of September 2021 by checks. Here, organization is making payments to its employees. Salaries expense for the month of September. So definitely, first of all, salaries expense is increasing here, and according to the rules, when expense increases, we debit it. So salaries expense shall be debited. And since the company or the organization is making payment through bank and that asset is decreasing, so we shall credit it. Illustration number 4, entity received rent income by checks. Now here the organization is receiving checks for rental income. Once again, the bank as an asset is increasing, we shall debit it, and our rent income is increasing. So according to the rules, we shall credit it, because when income increases, we credit it. And the last illustration, entity issued shares to raise capital. Now the company is floating its share to raise its capital. So what actually happens, the amount is received in the bank of the organization. So definitely the bank as an asset is increasing here, and it shall be debited. On the other hand, it's a capital, ordinary share capital here, it's increasing, so we shall credit it according to the rules of debit and credit. Thank you very much, and this is what we are going to cover in next video for the same topic. And in the next video, we will be covering accounting and profit equations and the accounting cycle. I hope you enjoyed the video, and thank you very much. And I would request all of you to subscribe to my YouTube channel, Study with Umair. Share, watch, like, comment my videos, and also press the bell icon. So see you in the next video. Till then, it's goodbye. Assalamu alaikum.